I was just talking to a founder. He had exited his business, started a second one, and he's like, I'm a shit investor, but I'm a great operator.
In order to be a venture investor, you don't have to really raise a traditional fund. With all the kind of platforms out there, like say for example, NonPublic or AngelList, you can start your own sort of syndicate and become a quasi VC.
Why would I subject myself to public market scrutiny if the same amount of liquidity financing is available in the private markets?
One needs to be mindful and not simply follow the herd because you give a good example. Just because SoftBank's put in money or someone else has put in money is not a good enough reason. Welcome to the Accidental VC podcast. Here's where we discuss founders, operators who have turned into VCs, oftentimes by accident, like myself and all the guests here. My name is Milan. I'm the CEO of NonPublic, which is a private markets investments infrastructure platform. And with me, my co-hosts, Dhruv and Shiyan. So over to Shiyan to introduce yourself.
Excited to be here, Milan. I'm Shiyan. I run an early stage venture fund called Hustle Fund, but my background is as an operator. And so I spent 6 years building a company in San Francisco. And then when I came back to Singapore, decided I was going to try my hand at investing. Over to you, Dhruv.
Thanks, Shiyan. Very excited to be here. Thanks for having me on the show, Milan. So my name is Dhruv Agarwala. I am the co-founder and CEO of REA India, which runs India's leading digital real estate platform called housing.com. Prior to that, I ran a fintech called I Trust Financial Advisors. And before that, I used to work for General Electric. So had extensive operating experience, started angel investing back in 2010, slowly and steadily, but became fairly active around 2020. And for the last 2 or 3 years, working very closely with Milan on many deals together.
Nice. Should we explore a little bit the topic of why we call this the accidental VC? So what was the accidents for you that have led you to VC investing? Maybe starting with you.
Look, I think it really wasn't an accident per se, but being an operator, I felt there was a lot of value I could add to companies myself. So when people just started approaching me for advice on companies, sort of seeking advice on issues to deal with, whether it was in terms of hiring, whether it grappling with a strategic direction, etc., etc. I felt that a great way to align our interests would be to invest in the company. And that's how I made my first investment. And then I realized that there's a lot of opportunity for sort of long-term wealth creation. And I decided to turn my sort of operating expertise into becoming an investor. And here I am.
Nice. What about you, Shiyan?
I think as an operator, you're kind of all in on one idea. And so when you meet other people who you think are pretty competent or really good at things that you're not good at, or working on spaces that you're interested in but wouldn't be well positioned to address yourself, you're kind of like, oh, maybe I can diversify myself through investing in them. So the first investment I did was in a business school classmate of mine. And he was one of those people, when you met him, you're like, I don't know what this guy's going to do, but whatever he puts his mind to, I think he's going to be pretty successful. And I wanted to be part of that journey and support him. And so that's kind of how we got into it along the way. And so there's an aspect of like, I have some competencies through operating a business where I can be helpful. And I also, to me, is I get to see part of that journey and learn about, aspects of different industries that I wouldn't have time to personally go start businesses in myself.
Oh, that's an interesting point to make, Shane, because I think one of the biggest benefits for me has been to learn from quality people, founders who sort of gone out on a limb, taken risks, and how they operate their business has taught me a lot how to run. So I think it's, to your point, it's a two-way street.
Yeah.
You contribute and you learn equally, not just about different industries, even how to operate your own business. It's been fascinating.
Yeah. Nice. Yeah, for me, it was, I guess, somewhat similar. I've been a founder myself since I'm 21. fell on my face a lot. And eventually, when I did have a little bit of spare cash, some friends were saying, don't just invest in bonds and SP 500 and do something a little bit more interesting and give back to the founder community. One thing I think is quite interesting about this topic is that actually there isn't a sort of clear-cut path to becoming a VC. I mean, I guess so you can study business or do an MBA, and some people do actually go directly into VC as a job, as a career, maybe start as an analyst and go through the ranks. But if you look at a lot of the partners of big VC funds, they had quite oftentimes operating backgrounds from very different walks of life. I guess one question is, do we think that being a founder first makes one a better VC? Is that necessarily true? It's certainly something that founders often say, right? We say, oh, this guy is just a banker. What does he know? Kind of mentality, right? What do you think about this?
I think it depends on what stage and on what you expect out of your VC. So I think that I was just talking to a founder. He had exited his business, started a second one, and he's like, I'm a shit investor, but I'm a great operator. And I said, oh, that's an interesting comment. I said, why do you think that is? And he said, I'm too optimistic, because he's a founder, right? He's like, I think lots of things could work. And so I get excited. I'm like, all right, But I think founders have that great sort of operating lens to be like, hey, I think this is going to work. This is not going to work. This is going to work. This is not going to work. I think for later stage VCs who are doing much more, maybe M&A, partnerships, corp dev, pre-IPO prep, a more maybe traditional finance background can be helpful. But I think in the early stage, there's no like professionalized VC path really, right? And so I think it's more like, are you good at assessing people, right? Do you think this person has got it? And I think also, are you a student of business? Which is not an MBA, I guess. And having 2 MBAs on this couch, right? I'm not actually promoting the MBA.
Right.
I'm just saying you're like, oh, this market is highly fragmented. It's going to be really hard to roll up this supply or something like that. Like, are you a student of those things? And I don't think you need any like formal education to do that. You just need to be someone who likes learning about people and businesses. And then you start kind of putting together things in your head. I mean, I think you know a ton about businesses. And
I studied design.
Yeah, but you're curious, right? You like read a lot, you make friends, you talk to people, and I think that's what makes you really good at your job.
Well, I don't know. I've only been investing for 3-4 years, so I've seen some data, but I think it probably takes 10 years to see if I'm really good at my job. But thank you for the compliment.
I'm going to add to what Shiyan said about sort of operators becoming VCs and sort of what that brings to the table. I think for me, I've experienced multiple VCs across my startups myself. And what I've found is that at an emotional level, operator VCs are able to connect a lot more. I think they're able to psychologically connect more with the founder, especially when, the going gets really tough and sort of critical moments happen in the business. That's when I think an operator VC understands what's really going on and is able to kind of help you get through that tough moment. And VCs who are sort of career VCs, being sort of bankers or sort of consultants, don't really understand some of the emotional, psychological aspects of what a founder might be going through in those tough times. I think that's where I think the difference really comes through. Otherwise, from a skill perspective, to your point, I think, if you're somebody who is curious about businesses, thinks logically, can break down stuff into, like problems into smaller chunks and then solve them. I think you can be a good VC from any profession, but I think it's the sort of emotional angle, psychological angle, which I think is very, very important. And just understanding a founder, when to push back, when not to push back. I think that's very, very important from my perspective.
Yeah, that's interesting. I mean, I can see that out of my own experience, having raised money from several VCs and sort of seeing the differences in how they behave in different situations, there are some really clear differences between I guess also the empathy.
Exactly.
On one level, really the empathy level of the investor at a board meeting or even just in general. There are some people that more naturally come to ask advice from, right? Because I sort of know that they've been through this journey and they might be able to give me better advice, or at least I feel that way. I feel like I will be met with more empathy. But I think, Shiyan, your point was interesting as well, that you need people who are interested in business, who understand business, one way or another. And I mean, I'm a you who are the MBA students, I have a design degree and sort of quite randomly found myself in the investing space now from being a founder first. And I feel my business learnings really came from being a founder and falling on my face. And oftentimes actually the failures were the biggest learnings. It's of course great to learn from other people's mistakes, but some mistakes you have to do yourself to sort of really learn it, which can be painful, right? But I think that's kind of part of the game.
You also don't really know how hard something is until you've done it.
Yes.
So like, I mean, I don't know how accidental I am, but early in my career, I was an associate at a late stage venture fund. And, part of my job was vetting the models that the founders sent back to us, right? And, there's this thing where you like copy the formula to the right and you like input the growth percentage, quarter on quarter. And I didn't really think anything about it. You're like, oh yeah, this is a reasonable assumption, copy to the right. But then when I actually had to operate a business and I had to write the plan and then I had to deliver that number every quarter, I was like, this is really hard. And so it's like, you just don't really know. You're like, oh, copying to the right, it's pretty,
I mean, 20% month on month in a spreadsheet is
no problem.
It's no problem.
But it's interesting you say that, Shiyan, because you're right. I think a lot of the business plans which you see, at least on the Excel, you see that sort of, customary hockey stick happening after a certain period of time. And you can be certain that it's going to take 3 years, 4 years longer than what's projected. But I think there's sometimes what I feel it also bogs me down as I look at companies.
Yeah.
Because I'm almost second guessing the plan I received, and I'm almost discounting what they've written.
Of
on
course,
the plan.
I call it works of fiction.
Works of fiction, exactly. So sometimes I can just take it to the extreme. So I think one has to really draw that fine balance. But I think being an operator really helps you diligence the company much better, I think. And you can see some of the real world operational challenges which sometimes prevent the company from growing at the pace they projected it to grow. Because you really got to on the ground, whether it's building distribution, whether it's tying up partnerships, whether it's making that first enterprise sale, all this takes time.
Yeah.
And that I think, comes from learnings as an operator.
What is the most common fictional device you see? Like, because you've been investing since 2010, right? So like, when people come to you and they're like, all right, Dhruv, I'm going to do this thing. You're like, what's the most common thing where that you're like, that's not going to happen?
I think people really, especially in like, a lot of people come to me for B2C businesses, there's being in that space myself. And I think people grossly underestimate the cost of customer acquisition, and they don't realize how much money they need to burn before they can get to scale. And that's something which people frequently underestimate. And I think that is hugely problematic because the amount of capital needed is so much more than anticipated that founders end up diluting themselves significantly.
Yeah.
And then they sort of start to lose interest in the business because they've been diluted down. So that's one thing which I think people should be seriously more realistic about. That the go-to-market strategy is where people sometimes trip up a lot.
That's true.
What about you, Shiyan?
I think that is a very common one. So I don't do much consumer. I do a lot of fintech, and I always say like, hey, in my mind, like fintech, there's like 3 drivers. There's cost of acquisition, cost of capital, and quality of your underwriting. And I agree, people underestimate CAC. Cost of capital, you can't impact much, right? You're kind of a price taker. Quality of underwriting, I think people always think like, oh, I have this new way to do credit assessment. Like, it used to be like, I have your cell phone data. I have, how many times you blinked at a camera. They always camera. And then, but the fundamental like limiting factor is like, does this person have money to pay you or not? Like, that's actually kind of the thing. It doesn't matter all this other behavioral stuff.
And how much data do you have?
Yeah.
Exactly.
And what is your means of collection? Can you directly debit out of their bank account? Or like you actually have to go chase them and, try to get money. So I think that's a little bit like people misjudge underwriting and they're like, hey, look, I have so much demand. And you're like, yes, because you're giving away $1 for 95 cents or whatever it is. And you're like, no, like actually we need to think about risk and underwriting. So that I think is specific to fintech is where I see a lot of fictional
No, I
aspirations.
completely understand that, because I've seen many of those in India myself, where folks come and say that, look, we've got this secret sauce around underwriting based on, social profiles, etc., etc. And I'm like, wow, I mean, that sounds a tall order. So people overestimate that for sure. It's a good point. Yeah.
I mean, coming back to the sort of accidental VC piece, I think one thing that's interesting is being an investor. I mean, an angel investor or VC. I think probably quite true for both. It's also a learning journey. So I found myself early on investing in companies that I probably wouldn't invest now, and I think this optimism bias that you were talking about really plays into that. That you think, wow, I love this guy, I love the idea, I love the the potential market, but my analysis was very light, right? Because I've not really worked as a VC before. So I think there's also this element of sometimes I have some VCs that I might personally thought they were, that didn't really understand the issues, they didn't really understand the business, they didn't have empathy, but nonetheless, they were still sort of picking holes into things from a very academic angle that still was quite useful. And in retrospect, I sometimes wish I'd listened to that a little bit more, because ironically, the academia is still something relevant. I have another story on this topic. One of my early investors in my first company was Ko Bun-wee, who's an, I think you guys probably all know him. He's an amazing guy, Singaporean sort of executive, closely involved with the GLCs. So he was a chairman of Singapore Airlines, DBS Bank, and Singtel, and now serves on the investment board of GIC. And I asked him one day, do you think I should do an MBA? And he said, Milan, why would you do another MBA? You just did an MBA and I paid for it. So I thought it was an interesting note. So I did probably also, based on that comment, sort of decide that I would not go back to study.
Yeah.
But nonetheless, I do feel I learned from the more kind of analytical, non-founder camp of investors as well. And it's interesting how it can trip you up. I think this dichotomy between energy and being a dog with a bone, and I think that's all very, very important as a founder. And you want investors who have that experience. And I think in a way, I probably personally also lean more towards that. I would rather take money from founder type VCs or founder type investors. But I do find I also get some value from, in our company, for example, having a chief risk officer of a large GLC involved can also be very useful, because they have an angle that's completely different to my personal experience talking about underwriting.
Yeah. I mean, I think the MBA, so okay, we should just disclose it up front now so that people don't find it out later. We did go to Harvard Business School, but don't hold that against us, okay? And I do think one benefit of the case method is you read a lot of cases of other businesses, right? Which is just like reading books or studying other companies. And then you have this guy failed because of this. This person succeeded because of this. And so, that you call it academic, but I actually think it's just pattern recognition from reading all of those cases.
Yeah, it's just getting frameworks, right?
Yeah.
Which I think just helps you structure your analysis of companies and situations. So I think there's, to your point, I mean, there is knowledge to be gained from all sources, and I think it's up to the founder who he or she kind of listens to and then sort of amalgamates all the information coming in and then figures their path out. Yeah. Never discount advice from anybody.
Yep. That makes sense. And how do you think how do you think the journey to becoming a VC has been in terms of your learning of, like, when you started to invest as an angel, as you sort of slipped into it, I suppose, in the early days, to now, after having done it for I guess for you guys it's 5 to 10 years.
So I did my first investment, Milan, in 2010, as I mentioned. So it's been about 14 years. And look, I still remain an angel. So I haven't formally moved over to the venture side. Dark side. But it's interesting. Sorry to digress, but now, in order to be a venture investor, you don't have to really raise a traditional fund. With all the kind of platforms out there, like say, for example, NonPublic or AngelList, you can start your own sort of syndicate and become a quasi VC. So I think it's a great way to learn the process of formally investing other people's money. But I think it's very different how you perceive risk and manage risk when you invest your own money versus other people's money. But yeah, I think one sort of big evolution which has taken place for me since I started in 2010 to now. I always say that entering into a deal is very easy. Exiting is always a challenge. And I never really estimated how hard it is to exit once you become an angel. And that's been a key learning for me over the 14 years that I've been investing. And I've become very, very particular now about exit opportunities, because ultimately at the end of the day, beyond the learnings you get, from founders, beyond just contributing as an operator, it is at the end of the day a financial investment. There is an expectation of return. And unless you're very, very careful about estimating where the exit is going to come from, I think it can become a pretty big sink of capital. So that's one place where I've increased my focus over time.
So the liquidity downstream. And I suppose there's an interesting point there. I'm guessing most of our audience here are founders, operators, VC folk from the industry, but also a lot of angels. And I suppose as an angel, you have a sort of slightly different outlook. You don't necessarily have to return capital.
That's right.
Aside from maybe the home boss, we'll ask about it. But as a VC, you really have a kind of fund life. So there's a clearly defined timeline. So I think that's a really important topic. I mean, we also think about this a lot in our business in terms of, is there secondary opportunities? Who will be subsequent investors? Would they be interested or open to secondary opportunities? Also in the context of obviously Southeast Asia versus US and other markets, the environment differs. What have you found sort of works as strategies when you look at companies? You might be looking at liquidity in 5 years or 10 years, or are you actually looking sometimes even with angel investing at taking liquidity as getting money back out as early as 2 years down the track? How do you think about that? How do you think about the timeline to exit or to liquidity from your angel investments at the time of investing?
Yeah, you go ahead, Shiyan.
Yeah, I mean, I think one thing I would add to that is I think angels can also have a different hurdle rate sometimes, which is like, I think as an angel, if I'm like, oh, I got 3x back in 3 years, that's like feels pretty good.
Pretty good, yeah.
But as a venture investor who has LPs who has different expectations, like they're kind of like, yeah, that's cute, but doesn't do it for me, right?
The return one fail, yeah.
Yeah. So I think that's a little bit what drives a little bit the timeline of the liquidity. So separate from like underwriting my own cash versus underwriting LP's cash, there's different, but also the timelines and the so I agree. So for us, we're pre-seed, right? So we're almost like angels in that sense, except that we have a hurdle of LPs who are, diversifying into the venture asset class because they want a certain thing to perform this way for their whole portfolio. And so every time there is an opportunity for liquidity, we underwrite it afresh. So we say, well, would we put in money at this level? Like, do we think there is actually more to go here? Or should we be taking some off the table? And so internally, so informally, we think if we're already up 50x from our entry point, then we should at least think about taking some money off the table to pay back the initial capital and then letting some ride, right? Because what we underwrite to on first check is 100x. So if I went into a business at 10 post, I need to believe it can at least be $1 billion business, right? And so if I got in earlier, there's some other opportunity. Hey, that's great. So we have taken money off the table in some situations where we got in really early. Some subsequent investor wanted a bigger ownership, but the founder didn't want to dilute as much. And so they said, hey, is anyone willing to take a little bit off the table because you guys were so early? And so it helps the founder, it helps us give some money back to LPs, but we still have a piece riding, so we can still try to get that additional turns on the capital.
And how have you found the response of both founders and larger subsequent investors, and how does that differ in different markets as well in your experience? Have you found that that's sort of easier in the US, for example, and a bit more tricky in Southeast Asia? I'd be interested in understanding your experience with that sort of over the years and how that's developing across different markets.
I think when things are hot and there's demand for the deal, the founder doesn't care. The founder's like, yeah, give me my tens of millions round. Oh, you early investor, you want $1 million off? Oh, okay, whatever, right? But it's very binary, right? It's like, if it's a hot thing and the founder is trying to get that deal done, they don't actually care. But if it's not hot and you're kind of being like, I need liquidity, the founder's like, yo, help me out. Why are you doing this to me? This is so. I don't know if it's a regional difference. I think it's more a function of supply and demand for the deal. And it may be regional in that there is a deeper, more liquid market in the US. So that generates more demand. But at the end of the day, I think it's also about the quality of your relationship with the founder. So sometimes I can go to a founder I have a good relationship with, and I'm like, hey man, we're at the end of our fund life for this one, and we would love to be able to show some liquidity. You don't mind if we take some money off the table the next round? And in general, if you have a good relationship, they kind of understand, right? Like, and they're like, yeah, sure. If I can make it happen, I will help you do this. If you don't have a good relationship with them, it doesn't matter.
It'll be difficult.
Yeah, and just switching gears, but let me ask you, so what sort of prompted you to start NonPublic? Why now? What's the journey been like so far?
Yeah, we actually started an angel club to begin with, which you were a part of, and that was also very much by accident. It was really me trying to invest my own money into startups and sort of realizing that if you want to co-invest with the best, if you want to co-invest with the sort of top tier VCs, for us it was really focused on Southeast Asia to begin with, and then we moved more a little bit broader by going into also some European companies, some Australian companies, some US companies, and moved more into later stage, which is the next topic we'll discuss a bit more shortly. I realized that it's actually not so easy to deploy my $10,000 check. So I started with $300,000, and so I moved into $500,000, and I wanted to do 30 to 50 times $10,000 checks. But I didn't really want to do really pre-seed seed. So we actually tend to invest a little bit later than you, Shiyan, because of sort of risk diversification, and because we don't have an element of control as angels. So I felt I listened a lot to Naval Ravikant, which I think most people know. If you don't, I think this podcast will be also great to listen to. It's called Spearhead. You find it on Spotify. And this idea of that you wanna invest with people who understand the topic deeply. If you don't understand it deeply yourself, and it's always good to co-invest with bigger players who can influence outcomes at whatever stage they're at. And I figured that at the stage I'm investing at, I will not be able to significantly influence outcomes. I can help and I can add value, maybe to some extent here and there, but I'm not going to join the board with my $10,000 check at a kind of post-seed pre-A company. And so then we started to essentially have a group of friends. Most of them were also accidental VCs, were essentially founders, operators who made some money, had exits, and wanted to invest their money. We were very lucky to get really some of the who is who in the Southeast Asian and also Indian ecosystem, like yourself, Dhruv, to join us quite early, and that gave us, I would say, really a great level of access. So the group went from sort of 10 people to 50 people to 100 people relatively quickly, and that allowed us to then write in aggregate $100,000, $200,000 checks into individual startups. And so this journey sort of led us to eventually realize that, hey, we are really onto something here. This isn't just a hobby. Again, back to the accidental piece, it was really very much by accident. I was still the CEO of another company, which we exited a couple of years ago to a big German company while I was starting this angel club, and never really thought of it as something that I would do full time. It was more, I guess, really a financial part of my financial investment strategy. I do invest the majority of my money into very traditional assets like bonds and public equities and property. Also, I have 4 children, so that makes you kind of want to be more conservative. And I think that's probably the right way of thinking about it. But I did want to have exposure to that asset class, right? And that was really the start. And as this developed, my co-founder and me, Cheng Wei, is over there sleeping, I think, at the moment. We were thinking, well, what do we do with this? We're sitting on something here that is really quite interesting, and also doing it at a sort of volume that's probably up there with the other bigger angel clubs, if not larger already.
And what I found really interesting, Milan, was the fact that for every which came to the syndicate, I think you had a ready-made pool of founders who kind of intimately knew the industry or a similar business, and were able to help you diligence. I think that's been a key sort of factor for your syndicate.
Absolutely, for the early success of this, of the angel syndicate, exactly. So that's sort of how it started, and then at some point, Chengwei and I, my business partner, were talking and sort of wondering where this goes next, and we were thinking, do we want to be a VC? Do we want to launch a fund? And we sort of figured actually there are already a lot of funds. Southeast Asia, I think, doesn't have a undersupply of capital. I think it has an undersupply of exit opportunities and liquidity. So we sort of felt that, why bring sand to the beach? We had a beautiful beach here right now. Maybe we can blend this in later. So we thought maybe that's not the right way to go. Also, we weren't sure if we were in the best position to raise institutional capital and so forth. So then we were thinking, well, do we want to be an accelerator? I mean, the thinking was that an angel network is a great thing to manage or to be a part of. It's a community, right? You're really adding value to people. You're adding value to the ecosystem, but it doesn't scale very well as a business. So we have 20, 30 SPVs. That's still okay. You have 50, 80 SPVs. Gets a bit harder. You have 100 plus SPVs. The reporting to the investors, even though you may not have a legal responsibility to do so, right? Because these are founder-driven vehicles, and the investors all do their own due diligence. There's still an ethical responsibility, right? To kind of to be the organizer who helps facilitate that updates are brought from the founders to the angels and so forth. We felt that is not something that you can scale very well. However, we also wondered, okay, what is it actually that works well, and what are we good at as a business, as a group of people? And that led us eventually to sort of realize that one thing that's missing in the startup ecosystem in Southeast Asia is a platform somewhat like AngelList, a platform that allows folks to set up SPVs, to syndicate, to set up their fee structures in there, and to bring together relevant angels. And this problem is not just faced by ourselves. In the US, it's very normal that if you want to set up an SPV, you go to AngelList or Sidecar, or there are several platforms. And there's sizable enough businesses. But in Southeast Asia, actually, a lot of people set up SPVs manually with a corporate secretary, with a lawyer. And in the beginning, it's very cheap. You pay $1-2 grand, and you think you got a great deal. And then the startup doesn't do so well, but you still have to pay for this SPV for 8 years, 10 years in a row. And so I think we thought there's something interesting there, and that sort of made us
So definitely a problem you were sort of trying to solve.
Exactly. So that made us think, okay, well, actually, the problem that we've been successfully solving for ourselves, Chengwei, my business partner, is a corporate secretary. I mean, our business model really is corporate secretary within the angel investing sphere, right? We can solve that more systematically for more other people. So we started to test that in a more manual way in the early days before we built the platform by essentially offering a corp like SPV in a box corpsec service for founders, for syndicates,
It's like an RUV. It's the RUV equivalent.
I believe so.
Yeah.
RUV is
Roll-up vehicle.
roll-up, exactly. Exactly. But that's what we call founder SPVs, and also LP co-investment vehicles for funds. So with several funds, at least 4 funds in Singapore alone have engaged us to set up SPVs for them, where they may bundle, where they have special opportunities that don't fit into their funds, or they have pro rata opportunities in their investments where the fund may not have any more capital left, but they want to offer it to their LPs. So there are actually a variety of sort of applicable scenarios where it makes sense to set up these vehicles.
Yeah. And what about the deals, Milan, in terms of stage, deal sourcing, etc.? Would love to hear some of that.
Yeah, so what we found, and maybe this is a good segue into our next topic, what we found is that there was an increasing demand and also supply from these fund manager and angel investor and partners, where people are increasingly interested to invest in later stage opportunities, even at the angel level, which oftentimes is actually not so available for
Access problem.
which is an access problem, exactly. And so as such, we also work with several fund managers now who set up vehicles to go into Series B, C, D, and later stage companies. But maybe to finish up on our company, so what we essentially then figured out, and not to make this a pure marketing play here, is that the interesting piece is really to automate the process. So our platform now, NonPublic, what it essentially does is it allows you to log in and to set up a vehicle as a manager, as a fund manager, or as a startup who is dealing in their own securities, and you can then use the platform to conduct KYC, AML checks, capital calls, investor onboarding, and also updates, and also reporting, and it aggregates your reporting across all your investments, so that you can now track as an angel investor or as a fund manager, you can track your MOIC, IRR on an aggregate level. So that's what we feel is something that is still missing. In the longer term, we really want to increase the sort of product suite to become, on one hand, a SPV platform, but also a secondary marketplace, which allows you to trade, to essentially create more liquidity between angels within the SPVs that isn't subject to ROFR. Of course, that requires some governance and considerations around how exactly that can work. You don't want to be seen market making. I mean, the founders might get upset at you if people start to trade their shares.
That's what happened to Carta, right?
Yes, exactly. Won't go into too deeply. I did read the letter by the CEO. I think it's not a super easy thing to do. I mean, in the US, you have obviously platforms like Forge and EquityZen, and I think an interesting thing is in the US, you have platforms like this that are purely focused on selling secondaries, almost as a brokerage sort of marketplace. So you can buy your SpaceX, Stripe, etc. And then you have AngelList, which is just, SPV in a box. Right? And then you have other businesses like Moonfair that allow you to do democratized access to private equity funds. I think that works because the US is a huge market. Europe is a relatively big market in comparison. I think India, you might have experience.
I think it is mostly AngelList right now, which is popular. And of course, now quite a few other platforms such as Venture Catalyst have sprung up. So, and again, there's huge supply and demand as well.
Exactly. So we felt it in Southeast Asia and Australia as well, which are sort of the markets that we're active in. We're just now preparing for a big launch in Australia, which is exciting. We're almost there. Our thinking is that in this market, it makes sense to bundle these services or these products, really. So a secondaries marketplace, access to late stage opportunities, as well as SPV in a box, if you will. So setting up vehicles for founders or fund managers. They belong in the same home to make it a meaningful enough business, because the market, I think, at this point isn't mature or large enough yet to allow for each of those to be large businesses within themselves. So that's what made us excited about the space.
Fascinating story.
Thank you.
And good name.
Thank you.
Because it's all non-public.
Yes, exactly. What do you do? Where the name is program.
As opposed to private, right?
Yes, exactly. Yeah, private, we did actually look at the URLs for private, but the problem is it gets into the kind of, adult space pretty quickly. So you got to stay away from it.
Okay. Got it. Yeah, you were talking about sort of the next piece being around late stage. So how do you see that evolving? Because even what I've begun to see, a lot of companies now staying private for much longer and doing tender offers, employees being allowed to sell, angels, even some VCs in many cases. How are you seeing that evolving?
Yeah, I mean, I think it's a now a huge thing that is happening where these late stage US companies who are raising money, as you said, they're raising money on tender offers, which is essentially selling early employee stock and early investor stock to the next larger guy, and these then get syndicated out through the next medium-sized guy and so forth. And this is already quite a common thing in the US, but I think it's also become, from a volume point of view, a whole different ballgame than it was sort of 5-10 years ago. I love your point of view, Shiyan. You've also been in the space for a while. So of course, for years, people used to trade some Stripe secondaries or Epic Games secondaries and so forth. So that's something that's been happening. But now with all these large private companies like SpaceX, OpenAI, Anthropic, and tens of billions of dollar valuations or hundreds of billions even, the volume that is being traded in this space is really quite significant. I'd love to hear your point of view on how that's evolving from your point of view, given you also invest in the US.
Yeah, I mean, I think if you think about when companies used to go public, right? Like Amazon, how big were they when they went public? Versus today, Stripe is multiples of how big Amazon was and still private, right? So I think a little bit post-financial crisis, the bar to go public went up. So there was a sort of regulatory structural reason for that. And then we were in the zero interest rate period where it was pretty easy to raise late stage capital. So it's like, well, why would I subject myself to public market scrutiny if the same amount of liquidity financing is available in the private markets? So that's sort of those things I think work together to create this situation. I think the other sort of thing was like over the last few years, a bunch of people raised money and they still need time. Their businesses still need time to catch up into those valuations. So there's another benefit to kind of like staying private for longer. But then you have these 10-year venture fund lives, right? So if you were an early investor in Stripe, it's in 17 years. Like your fund ended 10 years ago. Even if you got the +1+1 extension, that's still 12 years. There's LPs in that fund who are like, am I ever gonna see this money come back? Like, what's going on here? So
Your paper looks great.
yeah, like I want, there's no cash in my bank, right? So that's I think one aspect of it, which is like there is a like a structural reason where people are like, I need liquidity, right? Like, of course, if I could hold forever, why not? But I need liquidity. And then there are later stage funds who are like, I need to write bigger checks, right? Like, I need to write $100 million check. I can't go early stage. And so I'm going to underwrite this at this stage. I'm totally willing to pay these prices, per my underwriting. Where am I going to get the supply, right? And so I think that's parts of what's driving some of this expansion of the market. The market was always sort of there. It was just very hidden, right? Because it was all sort of offline. It's almost like the OTC market, right? It's like, I call you, Dhruv, do you have shares of blah, blah, blah? And Dhruv's like, I know a guy. And then, but then, you talked about equities then and Forge and some of these guys, it sort of made more visible some of these things and they were starting to, but I think what's hard about secondaries, as you mentioned, is you have these things called ROFRs, right? So there's a right of first refusal where if you're an existing shareholder, the company doesn't want you necessarily willy-nilly selling your stock to other people because you're still private, right? And so they always have a ROFR on, hey, now all the other guys get a first dibs or the company gets to buy it back. And it takes a lot of paperwork essentially to pass ROFR, get approval by the board to even buy that secondary directly. As you know, a number of people have been very creative and created, forward instruments, other sort of off-balance sheet types of agreements to say like, okay, you're not exactly transferring it to me right now, not on the cap table, but you promise. I'm buying you a promise that when that thing is liquid,
That's right.
right? So, we can have a conversation about how we feel about that, but that's like some of the sort of instruments that people are using to trade those things. But, as the market becomes more visible and more liquid, I think also boards are dealing with the idea that like, yeah, like I need to give my early employees liquidity. I need to give some of my early shareholders liquidity. Isn't it better if I control it than these people are running around on all these marketplaces? So then like, let me structure a tender offer, right? Like, let me work with an advisor and I will do it in a way that is like controlled and sanctioned by the company.
It's one of those things that you did mention that just given that companies are staying private, so this sort of late stage private deals offers opportunities for sort of employees, early stage investors to get out. I think my big worry, Shiyan, with what's happening now is that like previously, I think maybe 10 years ago, secondary deals were happening with sort of institutional investors or a small club of people. Of course, now you have super high net worth, family, so exactly. But now it's moving into the realm of retail. And that's where I see that risks are also going up. Because I think because of the reason you mentioned, there is no sort of real mechanism to determine pricing. So there is price volatility, lack of pricing transparency, big issue. Second is around diligence, right? Because again, there is no public market scrutiny, which is why people are staying private, and that's also creating sort of the risk that do people know enough about the company? So while it's in the realm of high net worth or ultra high net worth individuals or institutions, I think it's a good thing because it offers that sort of liquidity to early investors as well as employees. But as it's going more retail and more sort of mass affluent, I worry about some of these issues.
I don't know. So there's a great point. I was going to ask actually about this topic. So exactly. So what are the risks? What are the risks there on one hand, right? And I think you pointed some of them out. And also, what is the upside? What is the opportunity? I think they're kind of both really interesting questions. I mean, to your point, public markets sort of have evolved or developed. I think in a well, one can argue if markets are really efficient, but they're I would argue at least somewhat efficient, right? In a sense that the market gets made by the participants, and the participants are relatively broad. Of course, you have market makers who may push a stock up or down, a single market makers or people, corroborate. So that happens also in the public market. But here you could just have Masa-san, SoftBank saying, right, this company is worth this much, and then everybody else is paying the price based on a single large VC who is investing, I suppose, largely on
Spreading risk across various investments.
there's investments, yeah, exactly, and who's then setting the price for everybody else. And often also because of sentiment, I mean, I see myself falling into that trap, if you will, to say that, well, it's SpaceX. It could be a multi-trillion-dollar company. It's OpenAI. It could be the leader in AI. So there is a kind of sentiment-based investing that's based on belief, as you also said, without the ability to really diligence, without seeing a data room. If you're investing $20,000-$50,000 into such a company, you're not going to get to see the deck, right? I mean, the companies are too careful with protecting their materials, and so it's a good question. Originally, this asset class was really there only for super high net worth, and now it is starting to become more institutions. Exactly. Now it's becoming more available for you, kind of what I'd call retail millionaires, accredited investors still, who may have the ability to invest in hedge funds, etc., through their private banks, but historically may not have had access. So what does that mean? I think it's a good question. I'd love to get.
Look, my view on that, I think there is definitely a benefit. I think there is this opportunity for retail investors to get into high growth companies while they are private, because I do believe that even when they go public, there could be significant room for growth and hence for value creation. And some of these platforms, by bringing down ticket sizes, I think makes it a lot more accessible. The bite sizes are enough for sort of retail investors to be comfortable with. I think I was just pointing out that one needs to be mindful and not simply follow the herd, because you give a good example. Just because SoftBank's put in money or someone else has put in money is not a good enough reason. But I do think that it provides sort of liquidity to early investors and employees, and at the same time give retail access at a stage where previously 5 years ago they had none. So I think it's a space which is there to stay.
I mean, I think this goes back to just sort of like portfolio strategy, right? Which is don't invest more than you can afford to lose. And, it almost kind of has to do with like, what's your view on human agency? Like, should humans be allowed to make their own decisions? And sometimes they'll be bad ones. Or should consumers be protected? And I mean, people are betting money on Dogecoin and Trump coin and all these other things. That's all retail. There's sports betting is legal in the US. People are betting billions of dollars on those things. And you could take the view that like, hey, they're adults, they're free agents, they can do whatever they want. Or you could take the view, like, I'm Singaporean, right? And in Singapore, we're very like protective of retail consumers, and we say no, like, if you're crypto, you cannot advertise here. Like, you need to pay money to get into the casino. Like, you need to. So I think a little bit depends on kind of your view of like human nature, and like what you think is the role of regulators and governments to either enable people to be free or protect them from like their own sort of worst impulses. And so I don't know. I mean, I think I'm a capitalist. So in general, I'm like, hey, like, if you're a smart person, you've assessed your financial situation and you want to participate, like, I don't see why we should stop you, right? But I'm not a regulator, right? And so that's
no. Look, I won't even advocate stopping that. In that sense, I'm in your camp. I just think we just got to work out a mechanism to be a little bit more diligent about doing these, because to your point, sometimes people just treat it as a casino and just gamble.
Yeah.
So
Yeah, I mean, I would tend to agree with what both of you said completely. I mean, there's an element of, I think, this being a wave of something that's quite exciting, and I do see it growing a lot. Of course, I have a bias as well, right? Our business is sort of built on the assumption that this category of investments will grow significantly, and I do believe it will. On the other hand, of course, there are also a lot of risks, right? Because the pricing, I think the pricing of these assets, is not done in the same way that
Opaque.
it's opaque. It's opaque. It's not done in the same way that public markets work. So that makes it a tricky thing to consider. But on the other hand, as you said, there are other asset classes that are arguably much more risky. And
I mean, you could make the argument that Nvidia is a meme stock right now.
at this point,
So that's why I go back and forth on this, right? But there's a great podcast from Bloomberg called Odd Lots, and one of the hosts has this term, flows before pros. Right? So it's like, it doesn't matter what your analysis says, blah, blah, blah. If the momentum is there, people are rushing, flows are going to happen, right? So you can't fight it. You can't fight the Fed. You can't, so.
but that's a good point. I mean, even public markets are so sentiment driven to some extent.
All tough, right? So I don't know whether it's like there has been like a big shift in how people invest, but like as you open up more retail participation to any market, basically, I think there is an element in which sentiment and momentum will play a larger and larger role. And also the other one is that those are reinforced by algorithmic traders, right? So you've got the retail thing, and then you've got the algos kicking in to push that thing even further.
And I mean, depending on the asset class, I think at this point, there is a layer of protection by almost all regulators, at least that I'm aware of. If you look at the US, Europe, Germany, where I'm originally from, Singapore, Australia, where we
you have to be an accredited investor, right?
Exactly. You have to be an accredited investor, a wholesale investor, a sophisticated investor. There are different terms for it, but it essentially means you earn $250,000, $300,000 a year, or you have $1 million or $2 million in net worth, and that, I think, adds some layer of protection. I mean, I would certainly, not to give anybody financial advice. I think everybody has to make their own decisions. But for my friends or my children one day, I would think that private equity in general, so VC being the highest risk part of that, really, early stage VC especially, should only be a certain part of your overall investment strategy to be prudent, right? I mean, if you're single and you don't have kids, then maybe, I guess, different rules apply. But actually, recently I've read the latest Goldman Sachs model portfolio, and the only thing that grew is private equity and private credit, and it's taken away. I mean, we're talking about a couple of points here, but it is taken away from public equity in particular, right? There's nothing else changing from Goldman, if you believe Goldman, which it's
It's time to start non-public.
I suppose. But yeah, what do you think about that? Do you think that this is something that is here to stay? That private markets will be something that will be more common in, say, just high net worth or sort of mass affluence portfolios?
For sure, right? I mean, I think if you look at the big asset managers, they're all moving hard into private assets, right? And those are going to get distributed through RIAs. And so, it's like all the fees have been competed out of public, right? Vanguard's out there being like, okay, I'm going to lower my fees more. It's a 7 basis points, ETF or whatever. And Vanguard's like it's owned by its members, right? And so everyone else has to respond to that. And so if I'm like BlackRock or whoever, you're like, okay, well, now what do I do? I need to go to places where, compare like a 2% management fee to a 7 basis point fee. Like, you're like, okay, I'm going to go there, right? So I definitely think private assets are going to be a bigger part of it. And as that distribution kicks in through the RIAs, that's right. The majority of like sort of high net worth people, let's say $1 million to 10 million, they're not at a private bank, right? They work with, your sort of JP Morgan client services or Citi. Like, everyone kind of has like that band of like high net worth that they work with, and what products are they showing them, right? It's through these channels. So I think that's only going to grow.
I agree with that. I think it's going to grow quite a bit, because we just spoke about retail investors who are accredited. I think this is ultimately going to move towards tokenization. Like it has moved in real estate, where you can, start investing in chunks of like a few dollars. So I don't know, of course, how the regulation pans out there. But once fractionalization and tokenization happens, I think it's going to sort of reach beyond the mass affluent into sort of real retail, and which is going to make the asset class even grow bigger. So I think it is going to start occupying a much larger space in people's portfolios.
It's an interesting, sorry to interrupt, that's an interesting point that you just made. If it goes to that level where it's really available to retail investors, which I'm not totally sure about, but I think it's an interesting argument. Also, if it should, but it's an interesting argument because there's also this sort of reinforcing, self-fulfilling prophecy element there, where companies are staying private longer, and if you have more access to money in private markets to the point where it's coming from retail, does that mean that the incentive also for companies to stay private longer gets stronger? And is that a good thing? Because I think one argument I've heard many times now from believable people is that the reason for these big decacorns, $100 billion companies like OpenAI or SpaceX to not go public is to avoid the regulatory scrutiny, the reporting overhead, etc., and to kind of do things faster, more nimbly, and naturally the regulatory overhead of being a public company is there also for a purpose, right? So how does that dynamic work? I think that's an interesting question.
It is a trade-off, right? I mean, at one level, staying private for longer sort of gives you that breathing room, gives you that air cover to kind of be bold, take some risks, which otherwise you can't as a public market company. And there is sort of minimal sort of cost of, governance and compliance, etc. And the flip, of course, is the fact that you don't have that scrutiny can make you take risks, which are sort of, beyond what you should be taking. I think it's a trade-off and balance, which is why I keep going back to, as long as there's a mechanism which evolves to be able to do some diligence on these private companies, I think this sort of thing is here to stay. And I think it's a good thing if companies have that air cover for longer to take some bold decisions and take some riskier bets within reason, of course.
But governance is not always a bad thing. I think sometimes we also argue with it. No, but I think sometimes founders are like, oh, I don't want this investor. They're gonna like ask me lots of questions. And they're like, well, if you're gonna take their money, you probably should answer some questions. And like you said, right? You're like, hey, sometimes they make a good point. Like maybe sometimes I should consider those things. And I think as you get bigger and your business becomes more complex, like having an element of governance or outside voices is not necessarily a bad thing. And we shouldn't be so allergic to it sometimes.
Yeah, I mean, and I think this is super interesting. I haven't thought about it in that depth yet, but you just sort of listening to you guys talk, I think there's also this element of the technical pipes required to really facilitate. Let's talk about tokenization, right, for a second in that context. When then these companies go public, what is the process of then these private shares that are tokenized potentially by a blockchain? There's a bunch of companies out there doing this. That will be quite interesting.
Yeah.
And that will probably create several companies, I think, in the space. I know some in America. We invested in Securitize, one company in the space, that I suppose will have to make that possible. And at some point, ideally, you let's say you've invested via some tokenized platform into SpaceX and they go public. How long does it take until the shares arrive in your Robinhood wallet? So I think that those will be interesting.
You do know that most transfer agents have technology stacks built in the 80s, right?
It takes forever. Exactly. I mean, the reality is right now that it takes forever.
I have a portfolio company in this space.
Right.
That is trying to modernize the transfer agent tech stack. So Vinyl Equity, any public company CFOs who are sad about their transfer agent solutions today, check them out. But yeah, it actually is a problem. So like when my company went public, it took me over 6 months to get my shares because I lived overseas. And their two-factor authentication required sending paper mail to a U.S. address. I mean, really? In this day and age? Are you kidding me?
Yeah, we had some exits through some of the SPVs on our platform, and we've had the same issue. We had the same issue where we had to send people to German companies, especially,
Oh.
maybe part of the reason why I don't live in Germany anymore. They have to go to the notary in person to the
We go.
I mean, obviously I can't as some representative. We have to name a representative, and they have to physically go to the notary to just to approve a new shareholder or something. It's
Insane.
it's insane. Yeah. So that's the other element here, right? Is that I think the tech layer to actually facilitate the enablement of such trading, and perhaps, as you said,
An opportunity in itself. Yeah.
is an opportunity in itself, which is quite interesting. Well, to wrap up, maybe one interesting question is: what are you guys' biggest wins and fails, or what are all our biggest wins and fails in private markets? Your T-shirt talks about 4 gentlemen and ladies and gentlemen for GPT, Claude, Gemini, and Llama. The top 2 are multi-billion-dollar private companies. The bottom 2 are part of big public companies. I don't know if they fit into your fails and wins in private markets. I think.
I'm hoping Anthropic does well. We have a small check in there, but biggest wins and fails. I mean, I think it's a little bit early for the biggest. I'm hoping some of my bigger wins like grow into bigger things. But I wrote my first check into a company that today does like 50 million of revenue and continues to grow like super well. Has been super capital efficient, is in sort of like a global payment space, and I think has like a ton of growth ahead of them. So I'm like really excited about that. And I wrote the check before they'd shipped any product. So I feel like I'm hoping good. Biggest fails,
Many.
fails as in they went to zero, or fails like they were big but you missed it.
I think could be either, or just industry news that you think.
Lots of things go to zero, so there's too many to list. It would take too long, and I have a very big portfolio. I think my biggest fail is my mother always says this thing to me, which is like good deals have legs, which means you need to chase them. Like if it's good, you need to chase. And my business school roommate started a unicorn, and I was like, hey, like, can I put some money? And she's like, oh no, it's like very stressful. I don't want to take personal money. I'm gonna go raise studio capital. And I was kind of like, oh, okay. And like that was dumb. Like I should have just been like,
Yeah. Hey.
okay, just
Maybe the trash is the.
pushed. And yeah, so now like that is a lesson that I think about every day, which is like when someone says no, or I'm really like, I'm like, no, like,
You gotta be
like,
persistent.
what is the thing that because he's your friend, right? So you're a bit like paiseh, like
Yeah.
you're just like, oh, okay.
Emotionally appeal to them.
And then you're just kind of like, no, please, like, let's just do it. Let's make this happen. It's not a big deal. I won't hold it against you, like, let's just have it.
I'll do whatever it takes.
Yeah. So I think that's like my big fail.
Makes sense.
Yeah, for me, I think one of my biggest successes, of course, I think is I won't name the company here, but about to go public in India in the next 8 to 12 months. So I came in very early stage when it was valued at less than 20 million, and if all goes well, they should IPO at a valuation of close to 3 to 4 billion.
Nice.
Anywhere, the range is of course wide, but just don't know how the markets are. So that's my biggest success. Couple of more deals where early stage have been valued at over $500 million. But again, exits are still sort of some distance away. Fails, I think, I would say mostly, in companies. I mean, the money is stuck right now. They made decent progress, but I just don't know how they're going to exit. So I would say that's the biggest challenge I've seen at a portfolio level. Sort of no real line of sight in terms of where the exit happens. One company, of course, I think, to your point, Shiyan, we started out, which is listed in India at a multi-billion-dollar valuation. We started out at the same time when I did my previous startup, and we used to brainstorm a lot with the founder. And there was easily an opportunity there for us to have offered him stake in our company, and we could have taken stake in his. And we just didn't chase him enough.
Yeah.
I think it's so right, because at that point you're like, what are the chances? But I think sometimes when you're in the same business or in a similar industry, and you're sort of putting a lot of your eggs in your own basket, I think it wouldn't have hurt us and we put some money in his company.
Yeah.
So that would have really turned into a very good investment. So I think that's a very good point. It's not so much about the deals you do and which don't give you money. It's some of the deals which you don't end up doing, which are
That should have given you money. Yeah. I love that. Good deals have legs. That's a takeaway for today. Good deals have legs.
Or fast.
And you have to be willing to chase.
Yes, yeah.
You have to be willing to chase. You can't think that people have to always chase you for money. I think that's totally correct. I make a more Australia, Southeast Asia examples. I suppose my biggest win is relatively recent. Shout out to my good friend Brad, and I think our future co-host. He will join us at some point for exiting Hammer Tech, as Australian B2B SaaS. I just think it's great that you have founders from here, from the region, from sort of the eastern end of the world, building companies nimbly. Nobody knows about it. I mean, I'm sure people know about it. They do now. People know about it in the industry, but if I talk in Singapore about it, people have generally not heard about it. And it's just a great thing to see when people, build slowly, nimbly, build a SaaS company. Well, not that slowly, really, and get customers in the US, go to after a very specific market, build a SaaS business, and get a very decent sized cash exit. I think that's a big win for me, and it's great to see that, and love to see more of those kind of stories here in Southeast Asia and in Australia. Biggest fail, without pointing out any individual involved, for me is e-fisheries. I think recently, it's quite amazing that such a thing. And for those who don't know, it's a essentially sort of IoT for fishing, for shrimp farming business that had a massive fraud case, sort of inflated the numbers by about 5x, with huge investors, hundreds of millions of dollars raised. And I think how that went unnoticed, I think that's quite amazing. And maybe in another episode we can cover it more, although I think it's been also covered by a lot of people already. But yeah, those are my wins and fails on this episode.